Can you hear me?
Yes, we can hear you clear and see
Okay.
straight and forward.
Can you see me?
From Collette Handy. So
Okay.
you can hear me and there's no delay.
I can hear you. There's no delay. Only I can't fix the phone onto this device this way.
Oh, I see. Okay, just move on something because I like to engage with you today in regards to
Okay.
the Canadian Child Saving Plan because I'm passionate about it as we've discussed.
Awesome. Okay.
Yes, so for those of you that are joining in there, we have with us today Collette Handy. I just finished reading his bio. He's been in the financial industry since 1983,
Yeah.
in mortgages and finances. So this is really good. And today you're going to be enlightening us on, the Canadian Child Savings Plan, as well as, maybe some financial hacks just to navigate the
Can I?
economic. Yeah.
Yes.
So, what exactly, why is it important for us to be able to have control of our finances, have a plan for our finances?
Well, as you say, I've been in this industry for so long that if you've done something long enough, you become pretty good at it. From 1983 to my passion has always been how to find a way to make people better off financially. When I first got into the industry, one of my lessons was given to me by a lady whom shall remain nameless. In fact, I don't even remember her name. It's been such a long time ago. This was a lady that walked into my office and
Mhm.
she had $13,000 to invest. This is in 1984. The ironic thing about this lady is that she told me that she had put her daughter through school. Her daughter was now in college. This lady had worked only, she was a cleaner. So she only worked for minimum wage for her entire life. And I was
Okay.
thinking, how could this lady possibly save $13,000 in
Mhm.
school and put her daughter through school? Something occurred to me. It's not so much how much money you make, it's what do you know about handling money? That's what
Yes.
makes a difference. At the same time, that same night I'm working on that client's file, I was working on another file for a dentist who at that time obviously earns dollars, has a fancy home, fancy car, but owes the government $65,000, probably miserable lifestyle than this lady. so, so I'm thinking to myself, what is it about money that makes such a difference? Because of course, the amount of money that rotates around you determines your lifestyle. Why is it so important for us to know about money? It's simply because nobody is going to teach you that. And in general, the system is not designed to give you financial education. This
It's
is
true.
what, this is what we try to do, is give you education that you really won't learn in school. And even if you have a PhD, they won't teach you about finance in school. And this is what.
They'll actually even bypass it because I remember in high school when it came to, I think it was grade 12 math, and sometimes the curriculum runs out and we were supposed to learn mortgages and annuities.
Yes.
They skip this. Oh, we could just skip that. We could bypass that because we got this to finish up in the syllabus
Mhm.
and never learned it. So it's something that is often overseen.
Yeah. It, it,
So
it's overlooked quite often. I dare say that there are certain rules to succeeding financially. If not,
right.
it's like playing any game. If you play soccer, if you play hockey, somebody at some point has to get a hold of you and teach you the rules of the game. And based on that foundation of rules, you can develop habits that can make you successful. The financial system is not really designed to teach you the rules. It's designed for the few that control the system, make all the money. And most of us, and not only Black people, it's designed for the general public to not know what's going on and end up being behind and behind and being behind. For example, if you walk downtown in any major city, not only Toronto, any major city, most of the tall buildings you see are owned by whom? Generally the bank and
The
the
insurance companies.
insurance,
Yeah.
isn't it? Why is that? Do you think maybe they know something that we don't know?
Anywhere in the world. This is anywhere in the world.
Anywhere in the world, right? The banks and the insurance companies own the buildings. So just to dovetail back quickly to the lesson that that lady taught me, I learned something interesting about mortgages after talking to that. It's a matter of whether compound interest works for or works against you. She was $15,000 because she found a way of a little money she had compound and work for her. Most of us were letting money work against us, and I'll use it as an example since this is what I do every day. The typical mortgage, you look at it, borrow $100,000 mortgage, but you've repaid it after 25 years, you've probably made about $200,000 with you. And yet that interest rate may be 5%. Now, I don't know what kind of math that is, but there's nowhere 4 or 5% fits in 100% worth of interest in 25 years. But banks have a way of compounding this and doing it in a way that you will never really figure it out.
Hmm.
In fact, that's why I became a mortgage broker. I wanted to try to figure out how do people legally charge you 100 and people take it and get excited about getting it and smile and they go pay it for 25 years. It's because it was better. I think that teaching people interest and how compounding works can change their life. We all know, for example, if you have a credit card with a $5,000 balance, if you keep paying the minimum payment, it'll take you about 25 or 30 years to pay it off.
Because that's the hoax. That's the trick.
Uh-huh. And that's the trick that most of us fall into, isn't it? Right?
Mhm.
We think if we can manage the monthly payment, we can afford it. Really, what we're doing is managing the interest, keeping
Mhm.
us whole and in rut, right?
Yeah, this is so true.
Um, just to talk a little bit about what exactly is a savings plan. We this plan because we developed this plan because we realized that the easiest way to get a family on the right track is to start with their children.
This is it.
In the past, we have noticed that if you talk, which is what we do, if you talk to any, you ask them, well, do you have any savings? They probably have a little bit. Do you have a GIC? Do you have RSPs? Do you have this? Do you have that? Do you have savings for your children? Most people say, yeah, I have an RESP for my child. It's the
Yeah.
most common form of savings, right? Which is a good thing. There's
And it
nothing.
should be more common though. You know, I'm proud. I'm an R, but I am definitely an RESP. I put my kids through
Mm-hmm,
college with RESP, and I was actually a very young mom, and
mm-hmm,
it allowed me to encourage them, get them one or two of them through, and halfway through. You know,
mm-hmm.
so
Yeah.
I'm an
So
RESPs.
it's a powerful plan because it gets people saving for their children.
Absolutely.
It's necessary because when it's time for them to go to college or high school and that sort of stuff, it comes in really, really handy, right?
Yeah.
Uh,
Yes.
this plan was designed like an ARIA. However, because of our way of thinking, we're thinking this. You put money into something for 25 years, like an RESP, 20 years, 18 years, 20 years. Generally, people are investing until the child is around 18, college
Yeah.
age. Right?
16, 18.
Yeah. The only issue I have with an RESP is the fact that once you've used money, the plan dies. It's called an RESP, meaning,
Another child though, right? If you have another child, you can
yeah, exactly. But
generation.
once you use the
Oh
plan,
yeah. Okay. Once you use the money, it's
exactly.
done. It's done.
The plan is gone. So
Right.
if everything works well, you put
Mm.
the child reaches school age, then during the 3 or 4 years that the child goes to college, during those years, you withdraw all of the funds and then the plan it's designed. So our thinking is this. Because the biggest problem we have as a community is buying things that are temporary, that are permanent. the thought pattern is, suppose we can make something. Suppose we can do something with an RESP that has all the benefits of an RESP, but suppose we can use the money out of it and yet keep the plan alive. Suppose we could do that.
Okay.
That's how this whole idea started. And we thought, okay, so
What is it when you, because I know a little bit, so when you say that's how, what is this name? Is this a Canadian Child Saving Plan, or what is this product called?
okay, so I'm going to tell you exactly what it is now. Again, to go back to the foundation, we thought what we would like to do is create something like an RESP, but we want it to last forever. Well, how
Right.
do we do that? The benefit of an RESP is that the money within the plan grows tax sheltered.
Yes.
While it's growing, you don't pay any taxes on the money. If it earns $100 that year, that $100 goes into the savings. It's all growing. You don't pay any taxes on it until when you take it. Well, the only other way to do something like that is to run the money through a life insurance company. And now most people, when they hear life insurance, they run. We'll come back to that time to explain it totally. But the only way to shelter and have it grow tax sheltered and even get it out tax free is to run it through. Right?
You tipped out there is to run it through an insurance company, you said?
A life insurance company.
Okay, okay.
We've chosen Canada Life because they're the largest life insurance company and one of the oldest.
Okay.
Canada Life is one of the companies that what we call a mutual life insurance. That means that's one of the few. What does that mean? It means that the company doesn't have shareholders. The company is owned by the policy holders, right?
Okay.
So it means that any profits that the company make, it gets distributed to holders in the form of dividends. So this is something that most people aren't aware of because there aren't very many mutual companies. Most of them have become public companies, right? So that's
Okay. Yes, this is it.
Second criteria.
Most companies' goal is to be public. You know what I mean?
Of course, yeah. The second criteria of the company that we use is that the company has to pay dividends, right? In other words, every year you should get a return on the money that you're putting in. You see? And the third criteria is that it's something that can last forever. And with life insurance company, let me explain to you quickly how. A young mother decides to put $200 a month into a plan. Where she gets this money, I quite often say, because we did this because the government started giving $300, $400, $500 per child to people for their on the what's called the Canada Child Benefit.
That's right.
We started thinking, suppose you took $100 of that money and put it away for the child, right? You can do 20 years. They'll give you money for 18 years, so you have to put 2 years. So if you put 200,
You say they'll give you, oh, they'll give you, yes, they'll give you money for 8 years. Yes.
for 18 years for your child, right?
Yes.
So committed to this plan, which is a 20-year plan, you put $200 a month in the plan. I have an example up in front of me. So if you started with a child at age 2, yeah, you start with a child at age 2, put $200 at when the child reaches age 11, they will have $19,000, $20,000 away in that plan. When the child reaches 1, they'll have $54,000 in the plan, right? No, the money that they have in the plan is available to the child or owner of the plan, like the parent, right?
That's correct. Yeah.
So typically around 17, 18 is when the child needs money to go to college. So there's about $50,000 there. So what we encourage you to do, never kill the plan. Take the money out of the plan and leave the plan alive, right? So let's say you take 30,000 out of this 50,000, the child uses it for school, right?
Right.
The reason for doing that is the plan will continue to grow, almost as if you didn't take them out, right? And I know that sounds impossible.
Yeah, I already have questions already stirring in my head. Because
So,
I question because when you have the RESPs, it sometimes they mature earlier. What would you recommend, like the contribution? Because like I seen some of mine mature, but when the child was 16,
yes.
right? Then how does that continue on? Like,
This one never matures. And the reason it doesn't mature is
It
doing,
grows.
yeah, we're buying a life insurance policy, what's called a whole life insurance policy on the child. Now, because it's a child, if we're putting $200 a month, the cost of this policy is probably around $30 or $40 a month. The rest of the money is going into savings. Now, the savings are compounding and growing tax sheltered. Now, most of us think we can know how to save, but as I said, most of the buildings downtown are owned by banks and life insurance companies. I think they know something about saving. So
Right.
they know.
I know something about taking people's money, but I don't know it. Save it.
Saving through the life insurance company, the money that you're saving is growing and compounding and compounding. So back to my example, when the child reaches 18 or 19, you decide to take 30,000 out of the 54,000, you borrow it out, but are you really borrowing out of your policy? You're not. You're borrowing it from the life insurance company, using your policy as the guarantee. It's similar to buying GIC, and you go to the bank and you take the GIC and say, here's my GIC, it's $10,000. I want a loan for $5,000. I'm giving you the GIC as my security. They'll do that, right? And why they'll do that is because they're holding the GIC. The GIC is still growing in value. In other words, their security is increasing while you're paying interest on the money borrowed, right? So my point is, you borrowed the money, but your GIC is growing. It's a living asset, right? So that's what you're doing with it. You're
So now,
borrowing from the
is
life
this
company, but your money is still growing.
so you're saying that okay, so is this so an insurance is connected to the Canadian Child Savings Plan is what you're saying?
It is an insurance policy.
It is? Is this like one of the hacks that we don't know, or it
It is an insurance policy.
well, it can continue on is what you're saying?
That's right. It's a particularly designed policy. It's a policy that's designed to spit out a lot of dividends and a lot of value and not a lot of death benefit. So typically when
Living is what you're saying, access.
living benefits and not death benefits. So typically when people think of life insurance, and I wanted to particularly use that word because in our community, most people think life insurance is a lost cause. Because why am I buying something that's going to benefit somebody else after I die, right?
I'm sorry, my dignity, my dignity. I'm sorry. I have to have life insurance.
Absolutely. Well, I'm saying that because I know that's how some people think. And the reason,
It's true.
yeah, the reason they think that way is because they're thinking life insurance is for one purpose only, and that's called the death benefit. However, life insurance is not the death benefit. Life insurance is for the benefit as well as for the living benefit. The living benefit is the cash value that continues to grow, and that is something that is growing. As in this case, for example, this policy has 54,000, the one I mentioned. It started with a death benefit of 250,000. However, by the time this child is age 50, the cash value is 271,000, but the death benefit is 524,000. So what I'm suggesting to you, you can have your cake and eat it too. The money available to you is growing, but whenever this child dies, which will be way after you're gone, somebody's going to get $1 million, right? And this
But
is family healthy.
and the contribution though is carrying on, or does it stop at some point? Like like I know, like I've had a whole life insurance policy. I'm sorry, I went term, but I had a whole life and wasn't it just it ate itself out eventually because I wasn't contributing yet.
Well, you see, that's an interesting thing. Again, this is a specifically designed policy. And one of the things about it is that it only goes for 20 years. Payments for 20 years. After that, you stop. The policy will continue for the rest of the life of the child, right?
Okay.
And
Can you increase this as well, your contributions? Can you add? Can you contribute further, or you don't have to? Is what you're recommending?
you don't have to at all. Once you start the plan, you decide on what you want to contribute on, and it's a specific plan for 20 years. After 20 years, it's paid up. You don't pay any more money. If you wanted to contribute more, you have to have another plan. That plan is very specific. It goes for 20 years. And the key thing about this is that the returns that I'm talking are partially guaranteed. And the insurance company only institutions that can use the word guarantee. And the reason for that is because banks leverage. Meaning you can put $1,000 in the bank, they can take that $1,000 and loan $10,000 to somebody else. There's no real $10,000 there. They're leveraging money in the bank, right? Life insurance is not leverage. A life insurance company backing for everything they do, dollar for dollar, whereas banks don't.
Okay, okay.
So here's
Well,
the thing that we as a community, like me, you really won't know that kind of stuff. And this is why I want to be on this program, to be able to evoke some questions from and open these topics up, because they're topics that are very, very important to us.
this is it. And like, I mean, now your plan, what is your plan called? Like, so, I mean, like because you kind of went to the question of what's so different about your plan, because I'm hearing,
Yeah,
different formula or just as the way how it can work
yeah.
legitimately, and connecting it to an insurance policy, the RESP. But what is this plan called even?
This plan is called the Canadian Child Savings Plan, and it's a name that we've given to this particular way of designing this Canada Life policy and
Oh,
create a particular system for a client. So each person that we talk to, we're going to design a plan for that person based on the age of the child. And that plan will go from 20 years from the time we start the plan. It's a very specific plan. We set the whole thing out for the client. Client has access to whatever is in the plan, 90% of that at any time. It's very easy to do. They don't need us. Sometimes they need money. They can call the life insurance company. In 3 days, the life insurance company will issue a check to them.
right.
It's a very specific thing. So if you don't use the money, if you don't borrow the money out, you leave it until when the child needs it. I mean, it's up to you to decide what they need for, right?
Now, what is the latest? Like, I know, like for me, added my children staggered. I didn't start with my youngest daughter. I started with my eldest daughter. I started with the youngest daughter, and
Mm-hmm.
then everybody else got. So did bigger contributions for the eldest daughter because she was later. She started, if I guess, I think she was maybe 8.
Mm-hmm. Mm-hmm.
I started her contributions. What's
Mm-hmm.
the latest someone can start contributing towards their child's educational savings plan?
Well, typically we tell people the earlier the better. However, this is basically a 20-year plan that you can start at any age, right? So picture this. Because there's a life insurance component, there's a cost to life insurance. Now, the child, and this is why it's good for young children for their education. If you start at age 2 and you go for years, the plan goes until the age 22. If you start at age 10, you can still start the plan. It'll go for 20 years from age 10 to 30. However, the cost of insurance for a 10 is more than the cost of insurance for a 2. So
The
if you,
cost of insurance for an adult,
yeah,
for
the older, the
not
higher,
for yes,
yeah. So a 10-year-old, the cost of insurance will be more than, say, a 2-year-old. So
right,
to compare apples to apples, if you put $200 a month for a 10-year-old and $200 a 2-year-old, you see, 20 years down the road, the return will be higher for 2-year-old only because the cost of insurance was higher.
right,
Just
and
2-year-old,
like time.
smaller amount for the 10-year-old.
So, hmm. When you're so this is I'm actually gauging what it is. So it's not so I've been saying RESP, but this is a child savings plan.
It's a
Period.
child.
So you can do if the child wants to travel at this point when
Mhm.
it's maturity, 20 years, this is the time. Okay, I get it now, so that they can actually travel. And as I'm figuring it out and understanding what you're sharing and appreciating what you're sharing with us today, I
Mhm.
want to encourage our listeners, our viewers, to put in your questions. We're going to be here for about another 30 minutes with Collette Handy from Fairchoice Financial. You can put in your questions on the bottom right-hand corner. There's a little icon with a question mark, and you can put in your questions if you have any questions with regards to the child saving plan programs. This is something innovative. Is this something that only your company is offering right now? I know you've been in the business for a while, and I'm like, this guy's an innovator. This is what's going on,
Yeah.
you know?
Well, to put it this way, what we're using is a Canada Life policy, which is available to any life insurance agent.
Right.
It's an application that we're using this product and a way of designing it, right? If you ask any life insurance agent, the things that I'm going to ask now, such as if I have a whole life plan, can I take money out of there? The answer is yes. Anybody will tell you yes. If you ask them, and I'm provoking these questions because these are the things people would typically think, right? Okay, if I have money in there, what do I have to do to get the money out? Do I need to qualify? The answer is no. All you have to do is to identify yourself and prove that you are the owner of the policy, right? Company has 3 days to issue. You know, we're in the mortgage business. I can tell you, there's no place you can borrow, even if you have lots of equity, without them asking you about income, having good credit, and also
Mhm.
you want to use the money for. If you have money in life insurance policy, this one, any whole life insurance policy, you don't need to prove anything. Just prove that it is you, and you can borrow the money out of there, right?
Yeah. It
So,
is worth borrowing the money out of it is bothering me though, because
ah,
I've had
wait,
problems like
that's that, yeah.
the RRSP had
Hmm.
one moons ago, never will have one again. I don't
Yes.
want to borrow my own money. Now, when you say this, when I hear the word borrow,
Hmm.
what can you just break that down just a little bit more with regard to your plan? This, you know.
Absolutely. We use the word borrow for a particular reason, and it has to do with taxes. Now, you know, anytime you hear a product that has the word R in front of it, like RESP, RRSP,
Mm.
that stands for registered, right? Registered means, I call it restricted, but registered means that it's a government plan that allows you to save on taxes. It's all about taxes, right? So an RRSP allows you to put money in, it grows tax sheltered, and you pay on the exit, you pay taxes on that money when you take the money out of the RRSP, right? For that reason, most people are afraid to take money out of the RRSP because they're going to pay taxes, right? And they put it in because they get a tax deduction when they put it. However, with this plan, with the Canadian Child Savings Plan, it's all about taxes. The money grows tax sheltered, but the reason we say borrow is because if you borrowed money from somebody, is it a taxable event? You don't pay taxes on loans, do you?
Right,
Correct? You don't pay
right,
tax on loans, right?
right.
So can you borrow money from yourself? Answer is yes. If you have a house and you take a mortgage on the house, took money out, you're actually borrowing money from yourself, aren't you? Yes, you
Well, you're borrowing money from the bank. What do you say, though, as well, or the loan, or the?
yeah, you're using your house as security.
But this
And
is my contributions, and it's being invested. Why
right,
should I ever have to borrow money? This is what I'm like. This is. I'm.
you don't have to. You have choices. The first choice would be to collapse the plan and take the money out. But if you did that, you'll have to pay taxes on the growth of that money, right? But you can simply tell the company, look, I need a loan. So lend money out of my policy. They don't lend you money out of your policy, but they use your policy as security and lend you money. This way, you get the money, you don't have to pay any taxes on it, right? Now, when I say a loan, do you have to pay it back? Well, you really should. What will happen if you don't? Nothing, because it's your own money you borrowed, right? You can pay it back at the end of the year if you want, and you can never pay it back. Well, what will happen if you never paid it back? Remember, I mentioned to you that this two things. It has cash value and a death benefit, right?
Right.
If you borrow $50,000 from the cash value, at some point you pass away. When this child passes away, they're supposed to get, in this case, 524,000. They'll get 524,000 minus the money that you borrowed.
Oh, okay. I understand now.
Hmm.
I that works. That can go on.
Okay. Let me
Oh,
give you a real life example of a client, right? A number of years ago, this is about 10 years ago. The client,
mm,
we noticed, we used to do her income returns every year, and she's an older client. Right? She was in that time. We noticed that she had two 30,000 and 30,000. Classic example. So
She
we
had
don't
two policies, you mean? You said?
GI guaranteed income.
Oh, GICs. You chipped out a bit. There's a little bit.
GI is with the bank, right?
Okay,
Okay.
gotcha.
So she has two GICs. So we always question, why does this lady have two GICs? Separate ones, 30,000 and 30,000. What's the point of this? Because the 30,000 GIC in those days, it's yielding, I think, 5% interest. And
Mm-hmm.
5% interest, she has to pay on that 5% interest. So we're thinking about if you take away taxes and inflation, she's not really a lot on this. And
Okay.
so we asked her, why do you have these two GICs? She told me that it's for her grandsons. Okay. So I thought, well, what is the objective? Well, I want, when I pass away, that my grandsons are going to get 30,000 each, right?
Okay.
Well, it makes a lot of sense. So I said to her, well, the only problem is your grandsons work, they have income, and when you pass away, they probably won't get the whole 30,000. She said, what do you mean? I said, because in the year that this 30,000 goes to them, 30,000 will be added to their income. So the income tax bracket is called the marginal tax bracket. They'll go in a higher marginal tax bracket. So they're going to at least 10,000 is going to be gone out of that 30,000 in taxes, right?
Oh my.
She said, this is all about taxes. If you don't understand, the taxes will eat you alive. And the government loves it because they benefit from it, right? What did we do for that lady? Very similar to this concept with the Canadian Child Savings.
Mm-hmm.
We cashed the two GICs, 30,000 and 30,000, 60,000, and we bought a whole life insurance policy. In those days, you could buy what's called a single pay, whole life paid up policy for her. So that 60,000 bought her around, I think it was 480,000 or something like that of insurance, right?
Okay.
The lady was close to 70 years old. The grandsons are young. Now, here's a policy owned by her on her life with a death benefit of $480,000. Who are the beneficiaries? The two grandsons, right?
Okay.
When she passed away, what happened? Instead of them getting 30,000 minus taxes each, they got $480,000 tax-free between the two of them with the
Oh,
same $1,000, right?
the same 30,000.
Same
It's
30.
really that knowing really how to make the money work for you. And you guys, like, so with Fairchoice Financial, you guys actually work with people specifically to tailor, the best plan for them. Because I mean, like, not everybody has $200 a month to put
Uh,
aside.
oh,
But
absolutely.
I was using RESP. I'm not. I mean, try for you might for car payments, something, something.
Mm-hmm, mm-hmm.
So they can using not just because they have child tax benefits that they're, able to sacrifice the $200. But your company would tailor, what would work for
For,
them,
for a
make their money work
budget.
for them.
Yeah. Look, this can be done. I mean, we started doing these at $50, right? For children when they're really young, right? So you can tailor make the plan. Like I say, again, it's a life insurance policy. You can tailor make it to suit. The most ideal plan is 20-year plan, works the best. Typically, you need these days about $100 because everything gets more expensive. So the minimum amount you can do is 100. So it's about 100. But if we had to do it for $50, we can. The plan will spread out long. That's what will happen.
Yeah, with hopes that you could maybe increase contribution
Mm-hmm. Mm-hmm.
um, to
Yeah.
achieve, saving, like making that money work again. The lady's cleaning house, but she saves $13,000.
Yeah.
Was she investing her money? I meant to ask you, was
She
she
was
some
actually she was
investment?
GICs in the bank. Simple thing, getting 3 and 5%.
Like my mom. My mom did GICs for all of the grants. Yeah.
Yeah, 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 absolutely.
Yeah.
Absolutely. Mhm. You see, the only thing about a GIC is that it doesn't compound. What do I mean by if you
Gosh.
put $1,000 in the GIC and you get, let's use a round number. Let's say you
Three.
got $100 interest, right?
Yeah.
But let's say you got a 10%, you got $100 interest on the 1,000. Next year, that same GIC will yield another $100. It's not compounding. If you compound, what will happen is compounding means the $1,000 turns into $1,100, and next year you'll get percent on the 1,100 as opposed to percent on 1,000.
Oh,
Aha. So
okay.
that right.
That's better. Okay. Love
That's
that. Uh,
so the reason banks succeed is because, look, the truth is they always pay you simple interest and they charge you
okay.
they
So
charge
I've been
you.
asking a lot of questions. Does anybody out there have any questions on Instagram? We could just again, just gonna have a look still. I think I could see. You could just put your question. Oh, we do. We do. We have two questions here from Art Avenue. Art Avenues asked, if you decide to take the money out of your life insurance plan after 20 years, is the lump sum, is it a lump sum or
Or
an
an,
actual payout?
well, because you're controlling, whenever you decide to take out money, you just call the life insurance company and what you want to take out. You certainly can take some as whatever amount you want, right? Doesn't have to be monthly. You can take it all out at one point if you want.
Okay.
We tell
And then
people about 90% and leave 10% in there. That keeps the plan alive, right?
I tried again, that's why I don't do RRSPs because I tried that with RRSPs and I
Hmm.
told them to leave I think 10% some, of the amount in and they didn't. They just closed everything down and and I paid.
Yeah,
You know,
that plan is not designed to last forever. This
it's
plan,
I don't like it.
yeah, this plan is designed. Do you know, can I talk to you a little bit about life insurance? Because I think that it's something that it's kind of a myth. I want to bust the myth on
Okay.
how people think of life insurance, right? There are two ways to buy life insurance, and you mentioned it just now. You had a whole life plan and you bought term, right? Okay. So there are two types of insurance. One of them is most commonly known as term insurance. Uh, what is term insurance? Most of us have cars and we have car insurance, right? Well, car insurance is a term insurance. You buy insurance for your, typically it's annually. So every year you pay again and you get more insurance. And if you don't get in an accident, the insurance expires, buy more insurance again next.
Yeah.
We're used to that concept. That concept is called term insurance, right? Insurance for a term. And for life insurance, people are term for 10 years, term for 20. The issue is at the end of that 10, 20 years, the insurance will expire and you have to buy new insurance. And you're now 10 or 20 years older. So the cost of insurance is higher. So most of us who buy term at the end of the term, lots of times we don't even renew it because it becomes too expensive, right? So
That's what I'm afraid of.
that's
I thought
term.
I would never do term.
Yeah, and you see, that is the predicament a lot of us wind up with because we listen to the concept of buy term and invest the difference, only we never invest the difference. We just buy the term, right? And you get to a point where you get to age 70, 71, and you can't even buy any more insurance. Never mind afford it, they won't even afford it. They wouldn't.
What what is like if I was when I reached them time and I decided what would my term insurance possibly look like if I don't switch over to the whole life lot.
Uh, I want to give you an example of a policy I'm going to see somebody on Friday on. Right now, they pay a husband and wife. They've had the policy for a long time, and
Mhm.
so they pay in the vicinity of $200 a month. When they turn age 69, $200 a month is going to go to $800 a month.
Oh
And
man, no
every
way.
year thereafter, it's going to go to 900, and it's going to go to 11 per month. Who is going to pay it? Nobody, right?
Your own money then at that point,
Ah, so my point is, if you had a life insurance policy, this might
Mhm.
be a policy for you to sell because most people are going to pay and pay, never really going to use it, and they're going to cancel it before they get any benefits from it, right? And that's the reason people tend to hate life insurance because they buy the wrong type of insurance, right? Now, it's inexpensive. I don't say cheap, it's inexpensive. And that's why people buy it. However, other type of insurance is called whole life insurance. And what it means that you buy the insurance at a particular age, premium will never change for your life. And it means that you will be insured for the rest. So it means that from the standpoint of the life insurance company, at some time, some way, somehow, they will be paying out that money to somebody. So with the whole, they always pay out. With a term policy, 90% of the time, a little less, about 85% of the times, they never have to do anything, right?
Hmm.
So I encourage people, look at your situation carefully, because we have to plan down the road. And when it becomes down the road, it becomes more and more expensive, and it becomes prohibitive. You really won't even be able to afford it, right?
Right, right. And to be able to access it now is key. We have two more questions coming in. I have one more question here, a few more. We have um, Art Avenue is asked as well. What's the best GIC registered or non-registered?
Uh-huh. The best GIC, registered or non-registered, it
Mhm.
depends on location. Again, whenever something is registered, it means that it's growing tax sheltered. So that's the benefit. However, when you
It's
can,
oh, it's growing tax sheltered. You chipped out. Okay, good.
yeah, growing tax shelter. So if without knowing anything, if I had to just answer that question, I'd say the registered one is better because it grows tax sheltered. It's only when you take it out, you pay the taxes on it, right? If it's non-registered, every year you get income on it and you pay the taxes on it. So that's not a good deal. The registered one would.
Okay. That's something that I've never actually paid attention to.
Mm-hmm, mm-hmm.
We had access to the GIC, so I was like, here's your GIC checks. I mean, it's like
Yes,
not
yes.
really, really watching all, that whether it was registered or non-registered. That's a very good question. We
Mm-hmm.
have two more questions here. Steve Vadi has asked, do you have any life insurance that covers a 66-year-old for 250K? What would that like? How much would that cost? Yeah,
Um, it's
real.
always difficult. Yeah, yes, we do have insurance that'll do. It's often difficult to peg a cost, life insurance, because when you say 66-year-old getting 250,000, the key
Mm-hmm.
is going to be health. How strong is their health?
Oh, they're good. They're good. I think Steve is very healthy. Very.
Awesome. Well, yes, definitely we have policies like that. If they're and the truth is, even if they're not healthy, there are policies that are called guaranteed issue policies that they can also buy. So yes, there is that age for sure.
Okay. Well, I mean, we have your contacts. I mean, because they're just saying, because he's also asking, do you have any life insurance that covers 250K payouts oh, maybe it's the same question. Okay, it's the
Mm,
same question.
okay, yes, yes. Mhm.
So, go in a ballpark, like what would you expect to pay at 66? Like if you wanted to get that 250K?
I'm going off the top of my head, but
It's
probably
off the cuff.
probably about $300 a month, maybe.
Shit.
Hmm.
That's with the whole life.
Yeah, yeah, no, no, that wouldn't be a whole life. At 66 years old, you wouldn't get whole life. It'll be too expensive. You would have
Oh,
to go universal. Something that covers you to age 100, but whole life at age 66 would be terribly expensive.
you gotta do something. Like this is the thing. Like my attitude with this, I mean, I squashed my whole life. I ate it, let it eat itself out. But that's just life sometimes. But
Hmm.
it's like you have to have something. You need something, particularly in terms of life insurance.
You
It's
do.
like I mean, it's literally that springboard for the next generation, and it's something that namely, I'm not pointing out the Black community, but a lot of us do not reap the benefits of that. We have a lot of taboo thinking with regards
Hmm.
to leaving things behind. I do agree with, having benefits of finances today. You know,
Yes. Yes. Hmm.
I
Well, you see, Sharon, I think that one of the most important things is that most of us don't understand that life insurance is an asset. We don't have to look at it as something that we're just leaving for other people. It's a
right.
living asset that we can use now, and it's part of your portfolio. If you understand how to use it, it can be a
Mm,
very important part of your portfolio. Let me give you a quick example of a client on the other end of the spectrum. Now, we call this a Canadian Child Savings Plan, right? But
mm,
let's talk about how else someone who doesn't care so much about a Canadian Child Savings Plan can use this product. Let's look at a person who's a business owner, that's a very successful business owner, that typically puts $10,000 a year in his RSPs. Why does he do that? Because by topping up the RSPs, he's able to reduce his taxable income, right? Okay. So, but the problem with that is that when this person turns age 71, they have to start taking money out of that RSP, and they're paying taxes on every dollar that they take out, right? So if you need $1,000, you probably have to take out what, 1,400 in order to net 1,000, right? So it'll deplete your money fairly quickly. Look at a person like that using our plan. Instead of putting the money in an RSP, suppose this person chose to put it into a life insurance policy for a grandchild, a niece, a nephew, see, under their name. See how it works. So they put whatever, $1,000 a month or whatever, into the plan for this child, who is somebody who they know, a niece, a grandchild, or whatever, right? When they do that, who owns the plan? This grandfather owns the plan. So whatever money he's putting in under the child's name, he owns the plan. So he can call the life insurance company and take money out of the plan anytime he wants. So he's sheltering his own money, really, isn't it? But he's using the grandchild.
Legit though, like because I was trying to wonder who owns the plan. And so now you're saying it is the person who's making
Yeah,
the contribution, but it's a child savings plan
yeah.
for the child.
100% legit. A life insurance policy has an owner, a
Mm,
beneficiary, and a
right?
person insured. They can all be the same person, or they could be different people legally.
Got you,
The,
got you.
the grandfather will be the owner of the plan, the person insured will be the grandchild, and the beneficiary could be whoever he chooses, maybe the mother or himself or whatever, right? See?
Can
So
I do,
now,
can I do that? So in other words, what about that 66-year-old can
yes,
not open up the child savings plan
precisely, right?
after
And it's a financial planning tool because the money in the
how
plan
much a
is
month
an
just for 250, yo? That's
hmm You see, the money in the plan belongs to the owner of the plan. So the grandfather has access to this money to buy cars or do whatever he wants to do, like I do sometimes, right? But the child is insured for life. He pays this plan for 20 years. The child will have a few $1 million life insurance for the rest of their life that they never have to pay for. And at some point in time, the life insurance company is going to pay this 2 million or whatever the child is insured for out to somebody, to this child's beneficiary. So we're affecting 3 generations right here with this plan. You see my point?
okay. Absolutely. I do see it. I do see it. It's actually quite genius.
hmm
I think so Steve already has another question. I think that you did address it a little bit here, but is there a frame time when you get the insurance before it is available for payout after it's initiated?
That's a very good question. As I mentioned, most insurance policies are designed in such a way that they kind of piss people off because it takes 10 years before they have any money built up in the plan. This plan is designed that from year one, there will be assets being built up. And the rule is any money that's in the plan, you can have access to 90% of it. So my answer is from the very first year, you'll have access to 90% of whatever is in the plan, which may be 1,000 or 2,000 bucks. But yes, you can take out that money at any time.
I like that. That's good. That's actually really good.
Yeah.
It's something that I think we well have needed. I know we didn't get through all the questions, but I think you actually, I'm looking at the questions. I'm like, no, I think you thoroughly answered it, and we really appreciate your presence here today with us. For our listeners, I know it's as much as you are new to Instagram, you are not new to the business of finance. Oh, and let me just see. So I have some of the. If I'm not mistaken, can you someone has some more questions here. If I'm
Sure.
not, can you liquefy, okay, if I'm not mistaken, can you liquefy that money for your own use using LLCs?
Go ahead. Yeah.
Want to declare yourself a sovereignty and create your own?
The answer is yes. I encourage people to do this. It's like double dipping. Suppose you created the plan, borrowed the money out of the plan, because there's no restrictions, the answer to this person's question is yes, you can do anything you'd like with it. Suppose you took that money out and decided to invest it in something else. invest it in a house, invest it in gold, invest it in your business, invest it in whatever you feel like. So now what I'm saying is you took that money out, it's growing as if you didn't take it out, and the money you took out, you're investing it someplace else. So you're getting growth in more than one places, right?
Sounds good.
Now, who uses these plans? Just very quickly, because most of us don't know about this kind of stuff. Well, who does? I'll tell you who uses these plans. The banks use these plans. In fact, if you ever work for a bank, the bank has a life insurance policy on you, and the beneficiary is the bank, not you, right? For sure. Who else uses these plans? Primarily major corporations, companies like Walmart. Walmart typically has insurance on their employees. Most of their employees, when you walk in, those greeters are all pretty old people. The beneficiary to those plans are not those people, it's Walmart, right? And up until a few years ago, they didn't even have to tell people that they had insurance on them, right? So this is something that corporations have been doing for the longest time. To get a little bit more deep, a bank, if you look at any bank, what is the asset that a bank owns? The money that you put into the bank is not an asset for the bank. It's your money. So it's a loan to the bank. So that sits as a liability on the bank's balance sheet, right? See? The only thing that a bank really owns is the life insurance that they sell to you when you take a loan. You go and you take a loan, they say, yeah, the loan has to be insured. Well, that insurance, who's the beneficiary on that insurance? The bank is the beneficiary. So the only thing a bank really, really owns is life insurance returns. And life insurance returns are always tax-free.
Okay. Okay. This
Okay,
is
so
awesome.
it's
I really appreciate this wealth of knowledge. It's really, opened because I'm all about teach you financial people, teach us how to make money, not save money. Not what
yes,
we need to know how to make the money too, but
absolutely.
you're showing us take a muckle and invest this muckle at one time. So it's important,
Yes,
important,
yes.
you
Yeah,
know.
it's also important for us to teach our children some of these little fundamental things about financing. Little things
Yes.
like, when I first got into financial services, I read a book called Vanita Van Caspel, The Power of Money Dynamics. And I've always been fascinated by, she said, if you took a penny and doubled it every day for 30 days, you'll have, do you know how much money you would have? $10,742,000.
Pull up on that. Can you just tell me that one more time?
If you took a penny and
Mm-hmm.
you doubled it every day, which is impossible to do. But if you doubled your money every day, doubled a penny, start with a penny and double it every day, 30 times for 30 days, you will end up with 10,742,000 and something dollars, right? That's the power of compounding. Einstein said compounding is the eighth wonder of the world. It's really good. It works for you. If you understand it, it works for you. And if you don't understand it, it will kill you, because that's what's keeping most of us poor, is compound interest.
Oh yeah. Oh yeah. Well, we appreciate this. We have to stay in touch with you, Mr. Collette Handy. Can
Absolutely.
you tell our listeners, our viewers, where they can get some consultation, get some, more information regarding Fairchoice Financial and this amazing child saving plan? It's genius. It's brilliant. You
Thank
know,
you.
yeah. Please, if you could just tell our listeners.
Thank you. You can reach us by going to our website. Our website is simply fairchoice.ca, www.fairchoice.ca. And you can reach all of our services there, our mortgage services, as well as our Canadian Child Savings Plan and all of the other things. And, we're about education. To me, most of my speaking engagements are done especially to children. We sponsor children's programs. We sponsor programs for what we call youth programs, youth showcase, where they showcase their talent and all these things like that. Because we want to encourage younger people to have a role model and to strive for something bigger. And the truth is, people don't realize that we are the premier people of the world, and we are the ones that originated a lot of this knowledge. They will have us believe that we're dumb, but we're not. We're the ones who originated a lot of these concepts. In fact, even the concept of insurance goes back to our people. So it's something that we should take the rights to and go
Govern.
along with it.
Oh, yes. Thank you for sharing that. We appreciate
Awesome. Okay.
it. It's Lady Sharon signing out with Collette Handy from Fairchoice Financial. One love. Thank you for
Thank you
joining.
very much. Thank you very much, Sharon. And thank you, listeners, for taking part in this.
One love.